Well, I'm so glad you're all here today. And for those that are joining us virtually, welcome. I hope you're in for a tax journey as we uncover some strategic tax insights and how to really find financial success through our taxes. So I want to share this picture because we are in an age right now of automation, right? Everything's getting automated, automated marketing, automated cars, automated checkouts. And one thing I want us to keep in mind is much as automation is a great tool, sometimes we also get on automated mode. And I don't want your tax planning to become part of this journey. So I want you to put your glasses on as you get in your automated car and let's go and find some ways that we can open up doors of opportunity and maybe not miss opportunities because we have been doing things the same every year, year after year. So today's session is all about, well, what are the taxes and let's simplify it. What, right? Taxes can be so confusing and there's so many different types. We're going to kind of break it down. So hopefully today you're going to be able to walk out of this session and go, I understand a little bit more. And I know I have a lot of strategies that I can use. Now, how can I apply it to my situation? And what's the timeline that's the best for myself and my business? And exploring. So the goals I want you to do is really exploring your personal tax strategy. What are you doing? And if you're working with companies that you're working with them on consulting or coaching, maybe even think about their situation, their strategy, and could it be enhanced? And are they missing opportunities? Are you missing opportunities that might be readily available? Now, as we think about these, taxes simplified, I love sugar. And as a type 1 diabetic, it's probably not the best thing for me. But if you were to stand at the counter of the candy counter and say, well, you can only choose three, pick three, would you kind of be like, well, I'm going to miss out. I want to try more. I want to make sure I'm getting the right one and it's the right fit. Well, maybe it's the same in taxes, right? That you don't get yourself into a situation where you might have more or you could have been missing out, right? So let's simplify this. Everyone pays taxes in different forms, right? Whether you're making money, whether you're buying products, whether you own a home, in short, you're paying taxes, and this is all contributing to the communities that we live in to help make them run smoothly, to run better. It's all part of the process. And now it's how do we make it work for us, right? So there's different categories. And maybe as you think about the type of categories that taxes fall into, a few may come up, right? I mentioned a few already: income tax, sales tax, but there are others. And there's, as some will say, there's a lot, right? There are a lot of taxes. So here's some categories. And to keep this in mind as you're going through your strategy and how are you working through. So there's income tax, sales, capital gains. And I'm going to go through these each one individually because sometimes it's just good to get us all on the same page. And so we can powerfully move into the strategies and then we can look at what's possible. So income tax is required by all workers, regardless of employment status. Okay, how much depends on how much you're making. Sales tax, commonly used by states and local governments to raise revenue. Not all states have it, but most. Capital gains tax is imposed on your profits made from investments, either short term or long term. And payroll tax. It's a percentage of the employee's salary that goes to Medicare, Social Security, and unemployment. Property taxes, reoccurring tax by local government on the value of real estate or land paid by the owner. And that doesn't stop, right? That's reoccurring. Even if you paid off your home, you're still paying the taxes. Estate tax paid on the transfer of the property from the deceased to the heirs. And there is a changeover. So I did add this on this slide. If you want to look right below that box, it says that the current estate tax exemption for this year is 13.61 million, which is great because that's a lot that you can plan for. But in 2006, it's supposed to sunset and we're dropping down. So this could pose high taxes that your heirs are going to pay if you don't do planning now. And there's planning you can do, and let us know so we can get you connected. There's also travel tax. So if you're traveling domestically, internationally, how far you travel, there are different taxes. The airlines are charging it. You can look and see different types of taxes for travel, and even the sin tax, which is really luxury tax, which is you paying a little bit extra for those luxury items like cars, estimated over $100,000, jewelry, alcohol, and tobacco are examples. And there's one more tax that we didn't make a box for because only Michigan right now has it, and that's the VAT, value added tax. So when we're looking at these taxes as a whole, I want you to think of there's like three main categories that you can take action on based on your taxes. And you may know what they are, but I'm going to share them with you. The first one is you can pay it, right? Just pay the IRS what you owe and be done with it. You could spend it, right? If you have a business, you're trying to spend down as much as you can, or you can save it. There are different strategies around saving and how to put money back in your pocket for the long term. Now, one thing I want to just open up in the conversation here is we are giving strategies to help reduce your tax liability. However, you're going to be paying taxes at some level, way, shape, or form. If it's paying it by buying things for your business or saving it, there are tax credits. There are different things that can help eliminate a portion of that. But most of the strategies will fall into these three. Okay. Now, if we have any board game lovers out here, this is the game Catan. And the reason I'm showing this is because it's all about strategy, right? And I'm going to share with you a few strategies that you can use or look at for your business. But before we get started, I want to make sure we go through some disclaimers, right? Because this is a presentation. Everything that I'm sharing today is for informational purposes only. It should not be considered professional tax advice because each person's situation is unique and it can vary by location. And we strongly recommend that you work with a tax advisor to receive personalized advice tailored to your specific situation. And yes, we do work with clients on tax strategies, but this would be a meeting that we would have offline. These strategies, again, are for informational purposes only. So let's dive in. These are some common tax strategies that I'm going to share with you today. There's just a few, but I wanted to share with it because this session is all about strategy, right? What can I do to help my tax situation? Well, one of the things you can do is it's one of the easier opportunities, and this is in the spend it category, is expense acceleration. You can just buy or purchase things you need for your business now for the coming year. So you're purchasing this. Remember, this deadline is by the 31st. So December 31st. If you go ahead and buy something January 1st, that will be for the next tax year. You can use credit cards and loans to pay for some of that to help with cash flow. One thing I would suggest, though, is just to make sure that this is for the business and that you're not waiting till December. See if you can start to kind of spread this acceleration out if you can, if you know you're going to have a considerable amount of revenue that's beyond what you normally have, and you're looking to use the cash flow you have on hand to try to spend or expense, accelerate everything down. Okay, great strategy, easy to use. Next one is income deferment. If you've heard of this one, is just having your clients wait until the next year to pay you. So if you know October, November, December, this is looking like a pretty high income year, you can have your clients pay you, or you can bill them in the new year. Now, this is not suggested, obviously, for those that are not potentially going to pay you. You may still want to take the income now and provide your service. But for any good payers that are willing to work this kind of structure with you, this would be a great opportunity to go ahead and push it to the next year. Now, you need to keep track of this, right? So if you're not monitoring this or you don't have a bookkeeper, make sure you are keeping up with who you're pushing to the next year, and then have all that get paid out in your January. And don't overextend yourself. This is another good reminder that if you're doing this and your cash flow is lean and you have anything come through December and you're waiting for January, this could be a little bit of a tough situation. So make sure you're planned ahead. This is an implementation that must be done before December 31st. So as soon as you cross over that new year, then you would have the income paid out. All right, the next one, which is kind of a fun one. This one is done every year. So this one would have to be implemented by December 31st for it to apply to the year that you want to take this strategy into practice, and that's child employment. If you have children 7 to 22, or any of your children that are in college and not working up to 26, you could have them be on payroll, pay them a W-2, and have them have that deduction. Their salary will be a deduction on your business, and then the child will file their own tax return. So make sure that what they're making is going to make sense for the tax filing that they're going to do, and don't pay them more than what an individual single filer would pay taxes on, because obviously you don't want to pay taxes on what you're paying your child. The whole point is to give them enough for the work they've done, and then you can have that be a deduction. Keep in mind that children do need to clock in and clock out, and they do need to be working during that time. So you need to give them a task or roles that they're playing during that time and not work them too long or at odd hours that are not commonplace for a business, so you don't pose any risk of labor law rules. This is a high benefit. It does have a little bit of difficulty, right? If your children are in school, maybe they're working 1 hour a day after school, or maybe they're working 1 or 2 hours over the weekend and they're working mostly in the summer with you. So you could see how to plan this out for your family and for your business so it is workable. Audit risk is a little bit higher than the other strategies we've seen so far, and the aggressive, it is a little bit more aggressive. So just keep that in mind. Section 179. Now, this is a great tool for those of you that have bigger purchases. So if you're doing expense acceleration, that's one thing. You're buying things for the year ahead. If you have large office machines or tools or equipment, or even a vehicle or computer software, something that's larger than the normal just yearly expenses, it may fall into 179. And that's a great way to go ahead and deduct that whole entire purchase for that year. Now, a few of the rules to keep in mind. Now, this has a great benefit. It's not so difficult, right? It doesn't have too much of an audit risk. And the aggressive rating is, moderate, because you have to follow the rules of the section 179. And this must be done by the end of the year. So it has to be done in the year you want to take it. Now, there's those on the internet that share, I've expensed my Lamborghini as section 179 and took it as a deduction. Well, unfortunately, if they looked at the rules of 6,000 pounds or more for a vehicle, it actually doesn't qualify, right? Lamborghinis, if you look it up, the heaviest one that I saw was about 5,500 pounds. So it needs to be over 6,000. So most large SUVs would fall into that category. But just remember that this Section 179 can change each year. So if you think that you know the amount and you go off and purchase some large tools and all this stuff, and then it's not that amount, then you may want to rethink this opportunity and make sure and you're working with a professional on how to do it the appropriate way. And sometimes for your business, it just may be more beneficial to take the deduction over several years through depreciation, right? If you're expecting higher profits in the future, it may benefit to actually, go ahead and depreciate it out. But hopefully that one is helpful. The next one is the Augusta rule, which is it came from the masters, right? Those that would rent out their homes to this incredible golf tournament and enjoy a few days on the greens. Well, they would get paid for renting their homes and not have to show it as income. Pretty cool strategy, right? Well, it has to be 14 days or less, and your home needs to be rented to another entity for business purposes, such as meetings or events. And since the income is excluded from taxes, there's no need to report it, which is great. But it has to be 14 days or less. If you cross over that 14 days, it now becomes a rental property and everything changes for your setup. And you have to have documentation. It needs to be tracked. You need to do the homework of having a fair market rental rate. And this is really an incredible opportunity if you live in a neighborhood with a business professional that and you rent each other's homes. So you're following the rules. You're able to do the strategy. You're able to save some money and expense everything that you're spending. Just keep in mind there's other rules that play into this, right? Like if you rent the home, but only the bottom living room and kitchen is to be used, everything else in the bathroom, everything else is not to be touched, then this may not apply. So you have to keep in the rules of what this strategy allows. This has a small benefit. It's not a big one. Has a difficulty rating, it's a little higher because of all the upkeep and you have to track it. audit risk is much higher, and the aggressive rating is a bit more, and you must do this in the taxable year. So you can't do this in the next year. That would apply to the next year. All right. We're going to move into a few, and these kind of stair step up opportunities that you can use money for deductions from your taxable income that go towards your future for your retirement, right? Contributions can be tax deductible, which lower your income. Now, these investments in a traditional IRA are tax deferred. So you don't pay taxes on earnings until you withdraw the money after 59 and a half. And anyone that with earned income can contribute. However, there are limitations, right? With everything, there are limitations of how much you can put into a traditional IRA. And so you have to make sure each year you know what that limitation is. And withdrawals on retirement tax is ordinary income. So if you're looking at a planning for tax situations upon retirement, then this would come into play. And you have to start taking required minimum distributions at 73. There are some strategies if you plan ahead for traditional IRAs. And we could definitely discuss offline about that. Withdrawals before 59 and a half are subject to a 10% penalty plus income taxes, and some exceptions do apply. This is a high benefit. You can't put much in, so it's not like going to be extraordinary amounts of money, and you still are using your money, your taxable income, and putting it into another tool. This is a save it, right? Out of the three, this is a save it. It's easy to set up. It's got a low audit risk. You have to obviously contribute just the amount that you can, and a low aggressive rating. This needs to be done by April 15th of the next calendar year. Okay. 401k. So this one's great. If you want to put a little bit more money away versus your traditional IRA, you can move up to a 401k. You get a little bit more putting away for the future. And this is employer sponsored, so it accounts, employees can contribute and you as an employer can contribute. And if you're 50 or over, you can make an additional catch-up contribution. And if you're going to put more than $10,000 in a retirement account, this could be a much better option. Again, it depends on your liability and which tool is the right one. And you may have a vesting schedule for employees, which also makes it nice if you have a high turnover business and you want to offer a benefit and you want to be able to take the deduction. Overall, has a high benefit. It's low difficult, audit risk is low, and aggressive is low. It must be implemented by October 1st of the tax year, and then any contributions by December 31st. All right, a SEP. So the SEP is for any business size, which is great. So if you want to go from that 401k and take it up a little bit more, you can put more money away into a SEP, even if you're self-employed. Business owners can do this all the way through April 15th, plus extensions. It's easy to set up. You could even do it on your own through a brokerage company or work with a financial professional. There are different choices, very little paperwork, and all participants, and this is the con, all participants are 100% fully vested once a contribution is made. So if you have employees, they are in the plan and they are fully vested. If you do a different type of plan, you may have a vesting schedule. So keep this in mind on what your structure is and what your situation is, and definitely schedule a time or meet with your tax professional. Benefit, yeah, this is a good benefit, high benefit. It's easy to set up. There's low audit risk, and it's not so aggressive. And April 15th of the following year, plus extensions, you can do this strategy. Okay. A defined benefit. So let's go up one more. If you're looking for more deductions than in the SEP, you may benefit by using this strategy, which is sometimes called a pension plan, cash balance plan, 412(e)(3). They provide employees with a fixed pre-established retirement plan if they are vested. Now, cash balance, that has a ability to take a lump sum. The defined benefit says I have a fixed pre-established amount that I'm getting based on my benefit. So higher contributions with higher deductions are available through these plans. It is asset protected, and the plan, because it's set up as a trust, and you have flexibility on minimums and maximums. The growth is very steady, and business owners that are looking at this, ideally 35 years and over, they have a tax liability of 50,000 or over is kind of the standard. And if you have employees, you have an ability to have a vesting schedule for this strategy. It has a high benefit. It's a little bit more difficult. It says it's easy, but there are some steps and there are different players that you would work with your CPA, you would work with a financial professional, and you work with a third-party administrator that oversees the plan and keeps it IRS compliant. They have actuaries in that third-party administrator, so the plan is compliant with the IRS, and that you know how much based on what you're making, like what you're paying yourself as a W-2, what you can contribute, how old you are, and how many years to retirement. The aggressive rating is pretty low, and you can set these up actually through the year into the next year plus extensions. Okay, so cash balance plans, defined benefit, the cash balance plans you can actually set up all the way through the next year. So I'm going to show you this really cool, and I want you just to look at, find your age, and then follow that age down. You're going to see if you made $345,000, well, what could you do? And this really, I love this document because it really gives you an understanding of, if I'm making a good amount of money, what can I do? No matter what this amount is that I'm making, if I am in this simple, I would only be able to do 16. That's it. If I made less than 16, it'd be less. 401k salary deferrals, 23. That's it. 23,000. That's all I could do if I was 45. SEP, 69,000 or 25% of what I made. So that might be even less. A 401k profit sharing, 69,000. These are all defined contributions. So I'm only able to put what the IRS tells me I can put based on the plan. You'll see that it goes up at 50 only because you get to have catch-up contributions based on your age. So you can do a little bit more, right, at 50 for your 401k profit sharing, a little bit more, and that's the same, right? That's the same for the rest of these options. So when I'm looking at this 45, when I drop down to the defined benefit, remember we talked about this, the defined benefit portion, well, look at the difference. I could put 181,000. That's going to reduce my taxable income. So if I did that, I would be taking that off my what I made through the business. This would be coming off the business pays for this. So it's not coming out of your personal account. It's coming out of the business account for this defined benefit plan because it's set up for the business, through the business, and you are a trustee. Cash balance, these are a little lower. Why? Because you're able to take this as a lump sum or as a defined benefit, gives you more flexibility, still a considerable amount more than what you could do with a 401k profit sharing or a SEP. And sometimes you can even do a combo plan. So you could do a 401k profit sharing plan plus a cash balance. Now we're talking. And then a 412 E3 is the most restrictive of all these. But if you're making good money, it could be a good fit depending on your situation. Now I want to cover, before we get to the next section, I want to cover just a few additional and advanced tax strategies because sometimes we hear about these, and I'm not going to go into detail, but I want you to at least hear them so you could, schedule time or meet with your tax preparer and say, I heard about this. Could I do it? Right? Cost segregation. So if you have any property, ideally $500,000 or more, that you are going to do renovations on, or maybe you purchased it and you're looking for some way to help accelerate that depreciation and that schedule, cost segregation may be an option. You could even plan ahead if you're doing a renovation and sitting down. Now you can go lower than that, but there's a specialist that we use for this that they do the whole study and they can talk you through all the details if it's a good fit or not. Okay. A DST, if you are able to do, if you have real estate investments and you are doing rentals and you're looking to roll money from a sale of a property into a DST, this could be an opportunity or opportunity zone. If you have a S Corp and you're looking to have a plan that you can use for your different aspects of what you're doing in your, like your rent or your utilities, and you want to pay a portion of that, what you're making from the business for that accountable plan, you can get that set up with your accountant. And this is another strategy that is available through that. Now it's in addition to that home office deduction, and it can be beneficial. Charitable remainder trust, GCLATs if you're looking to sell your business. Also, alternative investments if you're an accredited investor. There are some really there's some options in there potentially for you, making over $250,000 a year or over 1 million in assets. ADA credit. Everybody should be taking advantage of this. If you have an ADA symbol on your website, you're paying for ADA services. And if you update your website, you can include that if you integrate this in. So just look at this opportunity of the ADA tax credit. It's not a lot, but a little bit helps. Even ESOPs, there's what's called retirement tax minimization strategy. This is around that IRA genre and what you could do with that. Some really savvy, advanced strategy. Tax credits and incentives, there's a ton. Which ones apply? It depends on the situation. Also, I have the QSBS, selling the business, if you want to look at that option. HSA, some take advantage of the health savings account. And the QBID, if you aren't over the threshold, this could be an option for you. And bonus depreciation, tax loss harvesting, and there are more. But at least this gets you kind of thinking about different strategies you could look at and then plan for. Now, our next section is all about the alchemy, turning iron into gold. But when you put your plans into place and you do it ahead of time, meaning I'm not waiting till the last minute till I'm retiring to make a strategy and put that into place. And if you're there, definitely get on a call. But sometimes you have more options to turn more of what you've done into gold. So transform what seems like heavy burden into an opportunity for growth and savings. Most people look at the tax situation and like, oh, but if you looked at it like, whoa, what can I do? Wow, it changes things, right? You're gonna have to pay it anyway. So instead of dreading it, make it work for you. And the alchemists sought to transform those metals, and you can reshape your future by making tax decisions today. So when do you start? Right? It's a good question. When do I start tax planning? Well, when it's painful and you're not sure how to plan, that's a good time to start. Right? If you're up to that point and you're like, I probably should be doing something, and how do I save more? Get on my calendar or meet with your tax professional, start talking about tax planning. When to really look at this. Now, because a lot of these strategies end on December 31st, you'll hear some say, oh, the beginning of the year, you can start your tax planning. I say start in October to December. Why? So you don't miss out on anything for that tax year. And as you roll into the next year, you either have it put in place or you're at least on the path to getting it implemented. And if you are working with a filing professional tax preparer and you're like, well, they're telling me to do this stuff, but I'm not sure how to do it. Great, reach out. We do guided implementation. So we could take what your tax professional is telling you and then helping you put it into place, because it takes time. And there are some strategies that you may not know where to go. And guess what? If you don't have a plan, you have a plan. Your plan is not having a plan. So you might as well take advantage of what you can do versus pushing it off till later. Experiencing major life events, another time to start tax planning. That might be marriage, having a baby, starting a home, purchasing a business, or starting a business, retiring. These are all great times to sit down with your tax professional and say, what do I do? How do I do it better? Also, before making significant financial decisions, if you're looking to retire or if you're looking at selling your business, these are big financial decisions that if you had a little bit more time and a few more options, you may be grateful that you actually took the time ahead to plan versus what do I have? Okay, I'll choose this. Pretty cool, huh? All right, so what are the benefits? Well, you're going to optimize your plan and you're going to enhance it. Every time, if you have a plan and you're able to put that plan into place, then you're just enhancing it every year. And you might avoid unexpected tax bills. That's awesome. And think about your estimated taxes, because I know there's a lot of business owners, including ourselves, we've done it too. You go through the year and you're like, I'm going to pay it next year. You pay the penalty, you pay your taxes. But it may be a good opportunity to spread that tax pain out, the tax opportunity out over the year and pay estimated taxes. So you're not coming up with a big tax bill and your cash flows maybe not going to be workable at that time. You've got some flexibility and you've planned ahead. You can also maximize your wealth building strategies, right? We talked about some retirement. those things are the save it bucket, and you're able to use that tax money to be able to help your wealth building. Pretty cool. So increase your number of options, right? That's another benefit. You just increase the number of options you have by knowing what you can do instead of saying, I wish I would have known. And hopefully we reduce a lot of stress. And we see taxes as a way to play and to make more money for ourselves and to use all the great things. Because if you're making more money, that's exciting. Now let's make more money, but from what you're making. Now, as you think about this tax situation in your tax roadmap, how you're going, well, do you want to go by yourself and try to navigate this thing all by yourself? Or do you want to have help? Would it be nice to have a guide? I always think of like, going on a hike or going to something. And it's like, if I didn't take a guide, I'm like, man, I wish I would have had a guide. They would have told me about all the cool stuff. And how incredible it is sometimes to just go ahead and find somebody you can work with to help you get through everything. Because can you do it on your own? Sure, you could find all the people and all the specialists and implement it. Absolutely. But how much easier and how much time are you going to save by working with somebody that can help take you through it? So I want you to ask these 3 questions. What would you do if the next 5 years were identical to the past 5 years? Now, I'm talking about this in the tax world, but if it looked the same and you're like, I should have done this 2 or 3 years ago, I should have put a plan into place. Remember, your plan is not putting a plan if you don't have a plan. And if you do have a plan, how could I make the plan better? But if my next 5 years look like my past 5 years, would you be excited? Would you be, like, I did great? Or would you like, man, I should probably look at that and maybe do some things now? Right? What is your strategy for higher taxes? Obviously, everybody's looking to grow, 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 grow. And that's awesome. We want you to grow your profits so much that you're just, hitting every goal you set. But now you've got the taxes. So how can you powerfully plan for that extra profit? And as you're going through all that stuff, there's so many great resources and tools to grow your revenue. And everybody focuses on this, but they forget that growing your revenue means you're going to pay more taxes. So how do I make this work for me? And we shared some tools and some strategies, but schedule a time, find out. And the third question is how would having a team to help you identify, to understand, and implement these tax strategies be of value? So you're not navigating this wonderful little maze over here by yourself, right? You've got a team. So my question, remember, I had 2 goals for you, that you would look at your personal tax strategy in this session. And the second goal was you would ask yourself, am I missing anything in my current strategy? Am I missing opportunities? And if so, what can I do today to find out what I can do? Okay. Some reminders. We talked about tax categories. If you remember all those tax categories, we talked about some strategies. We talked about some advanced strategies, just high level. We talk about the alchemy. How do we transform what we have? And really coming from it with a different set of lenses, and what missed opportunities are there. And obviously, most importantly, is what did you find valuable? What could you walk away and say, you know what, I'm glad I watched this because of this. Whatever it might be. It might be 1 thing, 2 things. It might be the whole presentation. Hopefully, you're going to walk away with something that gets you either thinking or taking action for you and your business. And if so, please feel free. We've got resources available. Please reach out to me. I don't have the QR code on this, but if you want to have some downloadable resources, I can give you the code. Complimentary strategy session always available to anybody watching these. This is just part of our give back. We can talk about your situation, see what might be possible. A specialist intro, if I can introduce you to anybody that might be helpful, or even working with us, great. Please come to a next upcoming roundtable. We love having a full house and being able to share some great strategy and great tools. And if you want to schedule that time, you can always use this QR code. And hopefully you found this valuable. And until next time, keep raising the bar.